Advanced Financial Accounting, Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship. We're going to be doing a consolidation of the two trial balances for the parent and the subsidiary in a consolidation worksheet. The major focus will be both down and upstream sales that are taking place. In other words, sales from P to S and from S to P. P will be recording using the fully adjusted equity method, the investment in S. We're also going to have the added item here of some sales that took place, intercompany sales in a prior year that haven't all been sold in the current year. So that's going to be a new piece from a prior practice problem that we looked at that was similar to this one. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We're going to have the information on the left. We're going to enter that into the blue area on the right. We're going to have our worksheets, and then on the far right, we're going to have our information for P and S that we're going to be consolidating and then entering our consolidation entry into the consolidation worksheet, the consolidation entries. And then we're going to go back to our information and see what we have. We have P purchased a percentage of S. P is the parent, S the subsidiary. Common stock, the purchase happened on January 1st, 2000X2. So that happened on 2000X2. And the purchase was for 70%. 70% of the purchase. So we have a controlling and non-controlling interest. The cost at the point in time of purchase is the $114,800. The non-controlling interest fair value is $49,200. The equity section, in essence, of S at the time of purchase, in other words, the book value, because this is going to be the equity section, is going to be the 70 for the common stock, retained earnings of the 25,000. We're going to be doing the consolidation as of 2000X3, which is going to be the next year. So it's going to be the purchase took place in January of X2. That means we had all of X2 and then all of X3. So basically 2 years later. Then we have the book value and fair value, same except for, in other words, at the point in time of purchase, 2000X2, January, the book value and fair value were the same except for equipment, which had a higher value of $22,000, 10-year useful life that we're going to have a straight line depreciation method for that increase in value that does include depreciation that we will have to be dealing with. And then we have the intangible assets were increased or higher by the 47,000. So intangible assets as well. That is also something that we're going to say that we need to amortize over 5 years. So there's going to be a future effect on it as well in the 2-year period, right? That we have 2000X2 and 2000X3 that we're going to have to account for the amortization and depreciation. Then we have the accumulated depreciation of S at the time of purchase, 50,000. And this is the stuff we're going to concentrate in on here. We have 2000X2 S sold inventory to P. So remember, this is where our concentration is, these intercompany kind of sale transactions. We're usually looking at the sales in terms of last year. In these type of problems, we always are going to look at the sales basically saying, hey, was there any sales that happened last year? And then to consider the amounts that hadn't been sold, right? And what's going to be the effect on the current year. And then we're going to be considering the current year sales, what took place in the current years, and those are the types of things that we're going to have to basically be reversing out. Now, the general rule is that if there was inventory that was a result of an intercompany transaction, a sale from S to P or P to S in the prior year, you would think that normally it would be sold in the current year, kind of like thinking like a first in, first out type of method, but that's not necessarily the case. So keep that in mind as we go through here. So we have 2000X2 S sold inventory to P. So the cost, so S to P, so S is the subsidiary, P is the parent, so that's an upstream transaction, X2 last year. The cost is going to be 30,000, the sales price 50,000. And then P resold in 2000X3. So notice we're saying that this took place at the end of last year, 2000X2, and none of it was sold. We're saying it wasn't sold in 2000X2. It was actually sold in 2000X3, and we didn't even sell all of it in 2000X3. So we had 29,000 left over in 2000X3. So I'm even going to say here it was 12/31 2000X2. So none of it was sold in 2000X2, and we didn't even sell all of it in 2000X3. That's a little bit unusual because usually you would think if the intercompany transaction happened in 2000X2, that whatever wasn't sold in 2000X2 would then be sold in 2000X3. In this case, again, the sale, nothing was sold or resold in 2000X2, and it wasn't even all sold in 2000X3 because we're going to say the sale happened basically at the end of the year. Okay, and then we have the 2000X3 S sold inventory to P. Now this is the current year, 2000X3. The S is the subsidiary, P is the parent, so it was S to P. That's going to be upstream transaction, cost, and sales price here. And then P did not resell by year end, so this is what was not resold. In other words, this is what was remaining in ending inventory. So notice we could say how much was sold, how much is still in ending inventory, 26,000 still in ending inventory. Then we have a 2000X3 P sold inventory to S, now parent selling to subsidiary, so downstream sale, cost, sales price. S did not resell by year end. This is what they did not sell, meaning what is still included in ending inventory that wasn't sold as of the end of 2000X3, the current year we will be working on, 8,000. And then we're going to be using the fully adjusted equity method used by P, meaning we're going to be taking these intercompany transactions into account with the equity method when considering the investment account and the income related to S on P's books. Okay, so we're going to go through our standard kind of process. We want to go through and think about these intercompany transactions in this format as we've seen in the past. Now, it's a little bit of a twist here because usually we would think about this and say, okay, there's going to be downstream transactions related to last year, and then upstream transactions related to last year, and then downstream and upstream related to the current year. But this time we had a little tweak here, a little twist, in that this transaction, that the one transaction that happened in 2000X2, there were no resales of that inventory in 2000X2, and it wasn't even all sold in 2000X3. So that's going to be a little bit of a twist, a little bit different than the prior problems, or probably the normal assumptions, which would be that it would be all sold from the prior year. So we're going to start off with the current year, 2000X3 downstream transaction. 2000X3 downstream transaction. We're going to be picking this up from this item. So I'm going to color it green. I'm going to kind of try to color them green as we go. And so this is going to be equal to the sale that's given to us of the 32,000. The cost of goods sold is going to be the 16. Subtracting those two out, we're going to say, all right, there's the sale minus the cost of goods sold. Then I'm going to get the gross profit percentage, 16 over the 32. I'm going to get the same for the cost of goods sold percentage of sales, which will be 50-50 in this case. Then we're going to see how much was resold. They said we did not resell 8,000. So this is the amount that was still in ending inventory. So that means that of this amount, we still have left 8,000. So we need a subtraction problem to see how much was resold, which will be the 32,000 minus, and then I'm going to pick up that 8,000. That'll give us the 24,000. Then I'm going to pick up 50% of that 24,000 for the cost of goods sold percentage. So 50% of that 24,000. Then I can take up 50% of this for the gross profit percent, or do the subtraction problem, 24 minus the 12, to get to that 12,000. Okay, and then we're going to do the subtraction to say, okay, this is what we had, the sales, this is what was resold. So this is what is reflected still basically in ending inventory. So we have the sales minus the 24, the difference, and then we have the cost of goods sold. I could take, 50% of the 8,000, or 16,000 minus the 12, and then I could take 16 minus the 12, or 8 minus the 4 to get to, or use the gross profit percent or whatnot to get to the 4. Okay, so next we're going to be picking this one up, the 2000X2. This is the upstream sale that took place in 2000X2. And then we're going to be comparing that and say it wasn't resold in 2000X2. So I'm not even going to set up, the amount that was resold or not resold. I'm just going to say that the amount that was resold in 2000X3, the portion that was resold in 2000X3. So we're going to be picking up, then this is going to be the 50,000 here. I'm going to go ahead and highlight this. So I'll highlight this or make it green. as we go. So we'll make the ones green as we go, so we know where we're at. And then there's the cost of goods sold is going to be the 30,000. Subtracting that out, the 50 minus the 30,000. Let's get the gross profit. And that's going to be percent, 20,000 divided by the 50,000. The cost of goods sold as a percentage of sale is the 30 divided by the 50. So 40/60 breakout. Then we're going to say that P resold in 2000X3 in the current year. So this was prior year. Nothing was sold in the prior year. We sold part of it. Part of it was resold in the current year. So part of it resold in the current year. And this is the amount that P would have resold, the resale here. So S sold to P, the parent. The P has it. Now P is going to resell it here in 2000X3. So they said that P resold 29,000. So we're just going to pick up the 29,000. This time they told us the amount that was resold, not the amount that's still left. So then we'll calculate the amount that's still left down here. So then we're going to take the 29,000. This equals the 29,000 times the cost of goods sold percent, or 60%. This would be the 29,000 and the 40%, or subtracting the sale minus the cost of goods sold. We could double check the percentage here to see if we're still at that 40%. So let's go ahead and check that out. Change the, there it is, 40%. Now we'll subtract it out. I'm going to say, all right, then what's left in ending inventory? The 50,000 minus the 29. That's going to be the 21,000. We could then take 40%, 60% of that, or we could do the subtraction again, taking the 30,000 minus the 17,400. We could then subtract the 20 minus the 11,600, or we could subtract the 21 minus the cost of goods sold. We could double check the gross profit percent here just to see if it's still at that 40%, and that is, so that looks good. All right, then we have the Upstream Transaction for 2000X3. So this is the current year Upstream Transaction, meaning it went from S to P. So here we got 2000X3 S sold inventory to P in the current year. So this was Upstream prior year, but then resold in the current year. This is going to be current year Upstream. So we're going to say that's going to be the 90. The 90,000 cost of goods sold is going to be the 50. Then we're going to subtract those out. So we're going to say this is going to be equal to the 90 minus the 50. Let's get the gross profit, 36 divided by the 90. Cost of goods sold over the sales, to pick that up as well, gives us the 60. Sales then, how much was resold? We said 26,000. P did not resell 26, meaning that's what's still in ending inventory. So, okay, so that means they must have sold the 90 minus the 26. So we're going to say, all right, they must have sold the 90 minus the 26 then to get to the 64. We'll take 60% of that, 64 times 60%, the cost of goods sold percent. We could take 40% of the 64 here, or subtract the 64 minus the 38.4. Let's check our gross profit percent just to see if it's still at that 40%. And it is indeed. So now we're going to do our subtraction problem, the 90 minus the 64, which will get us to that 26 that we had over here. This will be equal to the 90 minus the 64, and that's the 26. Then we're going to say the 54 minus the 38.4, or we could have taken the 26 times the 60%. Then we're going to take the 26 minus the 15.6, or we could have taken the 26,000 times the 40%. Let's check our gross profit percent, which is going to be the 10.4 divided by the 26,000, still at the 40% here. All right, now we're going to plug this into our standard kind of worksheet that's going to be helping us with our first journal entry. This is our standard kind of worksheet that we're going to be putting together. We're going to start with the net income that we'll break out, and then we're going to put in our adjustments to get the adjusted. Then we'll do the same for the net assets. To do this first, I'm going to hide some cells so we can see our starting numbers over here. So I'm going to put my cursor on M. I'm going to highlight on over to T, M to T. Right-click on the selected area and hide the selected area. Okay, so typically we're going to start off with our first journal entry, thinking about basically the net income that we're going to be allocating between the controlling and the non-controlling interest. The net income here for S in the current year, 2000X3, the one we're consolidating, is the 31,000. So that's what we're going to start with. I'm going to say, all right, let's pick up that 31,000. I'm just going to say negative of that number. This is the first thing we typically look at, or one of the things we consider with our first journal entry. I'm going to break that out between controlling, non-controlling interest, where we're going to take the split of the 31,000 times controlling interest, 70,000. And then you can think of the other side being the 31,000 times, I'm going to do it this way, 1 minus the 70,000, or 70% and 30%, which would be 70-30 split. And obviously these two then add up to the 31,000. Okay, so now we'll do our adjustments, which we can kind of think of as breaking out in this format of the prior year kind of adjustments and then the current year type of adjustments, down and then up. Down meaning going from the parent to the subsidiary, up meaning going from subsidiary to the parent. So these are going to be positive and these are going to be negative the way we set this up. Now there's not going to be any reverse of the deferral down. This is the prior year thing, and this would be down, meaning going from parent to the subsidiary, because we don't have any 2000x2 down transactions. We got this 2000x2 up transaction, no 2000x2 down transaction. So that is that. Then we're going to move to the reverse gross profit deferral up, and this is the one that's going to be a little bit strange, because we had this 2000x2 upstream transaction, meaning it went from S to P, but it happened basically at the end of last year, so there was no resale that happened last year, and we didn't even resell the entire thing in the current year. So normally we would take the amount that would be on the ending, the ending inventory of the prior year, because the assumption would be that we sold it in the current year. But in this case, that's not the case, because we didn't sell it all in the current year. So we're going to pick up the amount that was resold that we need to reverse in the current year, which is going to be this 11.6. So that's going to be the thing that's different here. We're going to be picking up then this 11.6. And then we're going to break out between the splits. I think it's 70-30 split. So it's going to be this times the 70%. And then this is going to be that times the 30%, or this times, let's say, 1 minus the 70 or the 30%. So there we have that one. And then the bottom two are going to be kind of like normal, what we would normally expect. These are going to be the current year ones for down and up. Down transaction, up transactions. So let's start with the down transactions. So this is for the current year. I'm going to make it a negative because we're going to be subtracting this out. Negative of this 4,000. So negative of the 4,000, this we're just going to be breaking out because it's the down transaction just for P, meaning down transaction, meaning it went from P to a sale from P to S, parent to subsidiary, in the current year. Then we'll think about the up transaction in the current year. I'm going to say negative of going all the way down to this 10,400. Now the up transactions we're going to be breaking out between P and S, 70-30 split, so that 10,000 times the 70, and then we can think of it as equal to the 10,000 times, and we could say 1 minus the 70 or the 30. There's the 70-30 split, and if we were to highlight those two, we're going to say, all right, that's the 10,004. All right, then we're going to sum these up, so summing these up, we'll sum up that, and then I'm going to copy and paste that across, and there we have our adjustment. This is going to be the thing that we're going to use for the first, consolidation adjusting entry to adjust it. Now, we're going to do the same thing down below, so the meat of this is the same now. So we're going to start with, we're going to basically take our book value, our net assets for S. I'm going to do that by saying the sum of assets minus liabilities here in the current year, not the year that the purchase took place, but the current year we're consolidating, or that would also be equal to the equity, the 146,000. That's our starting point, breaking that out between the 70-30 split. So this times 70. And then we're going to say this times, let's say, 1 minus the 30, or 1 minus the 70, or 30%. And then we're just going to fill it in with the same kind of fill in here, the same adjustments. So you could think of this as the other side of the journal entry that we'll be putting in place in essence. So I'm going to say, all right, or let's do it this way. Let's actually use a formula to bring them down. So we have a formula. So when you look at this worksheet, you know right where it came from. So I'm just going to say this is that, and then we're going to say this is that, that, and then we'll sum them up this way, equals the sum of these. I'm going to copy that and paste it down. I'm going to put a little underline here. So I did that quickly, but just note this is obviously just the same numbers. I just filled them in here. Okay, and then we're going to sum this up. I'm going to say, all right, this is the sum then of this, and I'll just copy that formula across. And so there we have it. So these are going to be the adjustment we'll have to that first journal entry on the asset side of things. Okay, so now we're going to consider the goodwill calculation, the typical goodwill calculation that we've seen in the past. This is at the point in time, we're thinking back in time, again, to 2000x2 now, when the purchase took place, to see if there was any goodwill. Let's take a look at that calculation. We're going to say, all right, the book value at that point in time was the common stock plus the retained earnings, assets minus liabilities equaling the equity section, which at that time was 70 plus the 25. That's going to give us the 95,000. Then we said that there was a difference between the fair value and the book value at the point in time of purchase of the equipment of 22,000 and the intangible assets of 47,000. So it was 69,000 higher. Therefore, the fair value at the point in time of purchase 2 years ago, 2000x2, was 164,000. The non-controlling interest we're given was the 49.2 non-controlling interest. So then if I was to subtract that out, that you would think the controlling interest would be 114,800, and we would compare that to what was actually paid, which was the 1148. If we subtract that 2 out, then we have no goodwill. So we don't have to deal with any goodwill in this problem. Okay, so now let's go ahead and unhide some cells up top. I'm going to put my cursor on K and then go to U, K to U. Right click on the selected area and unhide. And then we want to consider the equity method. So I'm going to hide the cells in the journal entries and just consider the equity journal entries here. So I'm going to put my cursor on Q to T, let go, right click the selected area and hide. So now we're thinking about reconstructing, in essence, the current year portion of this number. So I'm going to make this the red-yellow combo. So I'll make this yellow and red, and then I'll take that combo color that kind of stands out here. That's the point. It's supposed to stand out. And then we're going to put that here, and I'll put it on this side too. It's going to be 0 at the end of the day. Well, it will be 0 after we sum this up. So let's go ahead and, okay, it'll be 0. We're going to sum this up, and then we'll have to do our consolidation entries. Let's think about these two numbers first. So we want to think about how can we reconstruct these, because these are going to have to go back down to 0 once we do the consolidation entries. It's best then to think about how they came about. How did these numbers come about? So we'll do our normal equity method entries, and then we're going to think about this worksheet to think about how that would be included in our fully adjusted equity method. So normal equity method journal entries would be that we're going to say, all right, we've got the income that we're going to have to allocate, which is going to be a debit to the investment and a credit to the income in S for P's portion of S's income. So that would be, we're going to say negative of this 31,000 times our portion, because we're P, I'm considering ourselves the parent here, it would be the 21.7. That's going to be the debit and the credit. Then we're going to take this dividends and say P's portion of the dividends. That would mean that they eventually got cash, so we'd think that cash would then go up, and the other side would be going into the investment account. So we're going to say our portion of the dividends, P's portion of the dividends, because we're P, we're the parent, is 17 times the 70%. So that would be the normal type of process that we would have. Then we get into the weird stuff. Now we're going to start off with the normal weird stuff we've seen before, which is the fact that we increased the machinery and equipment and now the intangible. So let's start with the machinery and equipment, and that's going to result in an effect on the income statement when we consolidate due to the depreciation on that added amount. So that is going to be then a decrease in this income account, income in S, and it's going to be a decrease to the investment account because it's basically an expense that we're recording. So we're going to say, all right, how do I calculate that? That's going to be equal to, we're going to be picking up the equipment. We're going to divide that by 10 years. That would give us the yearly depreciation, and that's what we want for the current year. But then we want our portion of it. So I'm going to take that times 70%. So we're going to get the 1540. Then I'm going to do a similar transaction for the amortization. So same kind of thing. It's like depreciation, but amortization. So we're going to say that's going to decrease because it's like an expense. It is an expense that we're going to be including in our income from S account. And the other side is going to go to the investment, decreasing that. Similar calculation. I'm going to say, all right, what was the increase in the amortization? That was 47,000 divided by the useful life, 5 years. That would be the amortization expense for the current year times our portion of it, 70%. So there we have that. So there's the unusual stuff, the kind of unusual stuff we've seen before with the equity method. And now we're going to go to the unusual stuff that's newer, and that's related to our worksheet here, related to this consolidation process. So let's go through those items. Now we're basically accounting for this column here. So we're accounting in essence for this column. And so the first one, that 8,000, I'm going to say that's going to be an increase for the investment. And the other side's going to be income. And that's going to be for the 8,120, the 8,120. So, and then we're going to go to the next one. The next one is going to be the income. So remember, these two basically, the top half here are basically reversing kind of like the prior year, reversal entries. And now we're doing the current year, basically entries. And then we have the down and up transactions. So we're going to be going for the gross profit deferral down. We'll be taking this from P's column now. And this will result in the income account from S being debited, and then the investment account in S for the 4,000. So we're going to pick up the 4,000. Actually, let's say, I got to say negative of that number to make it a debit, and then the credit. And then we're going to be picking up the gross profit deferral up, the 7,280. That's going to be income from S and investment. And that's going to be, I'm going to say negative of that 7,280. Okay, so now we can kind of check our work. We can check this number, and we should be able to tie that in because this is the current year activity. And then we'll check the investment number, which won't tie in because this number up here is a balance sheet or permanent account, and it includes everything from 2 years ago when the purchase took place. So let's see if we can tie out the income account, and let's even color code this thing so it'll be easier for us to see. We're gonna say, all right, this one, let's make it like orange, and so this is going to be income, which is going to be this. This is going to be income is here. It's kind of hard to see because they look similar. It's going to be here. It's going to be here. It's going to be here. Whoop. Hold on a second. It's going to be here. And then it's going to be here. Okay, income accounts then are going to be equal to 21,700 plus the 154 plus the 6580 plus the 8120 plus the 4,000 plus the 7280. And didn't something happen there? But there it is. So the 10,420, that looks good. That ties out. And then the investment account, I'll pick up these, and we'll pick up the 21,700 plus this one plus this plus this plus this plus this plus this. That. Now that doesn't tie out, of course, over here because again, we don't have all the information from the point in time the consolidation took place. Okay, so now we're going to take this information, start our journal entries, finally get to the consolidation process itself. So I'm going to highlight from O to U to unhide these cells. I'm going to put my cursor on O, select on over to U, let go, right-click the selected area, and unhide. So now we've got our information to enter the journal entries. Now this first journal entry, we're going to be dealing with basically reversing S's equity accounts here and we'll deal with the investment account up top and the income in S account down below. Now, we could do this from our adjusted journal entry over here. I'm going to do it in kind of a two-step process so you can see the normal journal entry we've done in the past, and then you can see the adjustment we make to it. So let's ignore this for a second and just say, okay, what if I just did the normal kind of journal entry we do to reverse the equity accounts? So I'm going to do it the way I normally do it, which is like I start off with the investment. Here, I'm not going to put the amount. I'll think about the amount later. And then I'm going to reverse the common stock, retained earnings, and dividends. So I'm going to say, all right, this is the common stock. I'm going to reverse that out. And then I'm going to say, I'm just going to copy this. And for dividends and retained earnings, I'm going to pick up these numbers because those are going to be reversed. These two are credits. We're going to debit them. I'm going to put my cursor over here. I'm going to say this is going to be the negative of that number to make it go to 0. Negative of that number to make it go to 0. And then we have a credit here because this is a debit. So we're going to credit it to make it go down. So that's the same that we've seen in the past. And if we follow suit to what we've done in the past, I'm just going to say, all right, then I'm going to pick up the income from S, and I'm going to just use this number down here. I'm not going to tie into this number. I'm just going to use this number down below and use our percentage of it. So we would typically think this is how we would normally do it. We would adjust it here for our adjusting entry. But I'm going to do that in a two-step process here. So I'm going to say if we just did it like normal, it would be that we're going to take negative of that 31,000 and we're going to multiply it times our percent for the parent percent or the controlling interest percent, 70%. And then we're going to say, all right, and then we've got the non-controlling interest, which would have to be the other side we got to account for, the 30%, and just say, all right, this has got to be then the 30%. Which is going to be that 31,000. And I would calculate it as times 1 minus, and then pick up that 70. 1 minus the 70, or, of course, the 30%. So there we have that. And then we're going to take the non-controlling interest. Now we're looking at the balance sheet side of things, which is going to be this account. And that's going to be the net assets, assets minus liabilities, times the 30%. And this will be the net assets times the 70%. In other words, this amount here is tying out to assets minus liabilities are 146,000, or equity also 146,000. What we've done right now is that 146,000, which we will now allocate to basically parent, which is included in the equity section in the investment here, 70%, and non-controlling interest in the non-controlling interest and the net assets 30%. All right, so I'm going to say negative sum. Let's do it this way, and we'll highlight these assets minus liabilities times, I'm going to say 30% as brackets 1 minus, and then I'm going to take the 70%. So basically I just took the net assets times 30%. The net assets minus liabilities, or 146,000 times 30%. Let's take that same amount times the controlling interest, 70%. So let's say it equals the sum of assets minus liabilities, and then times the 70%, times the 70%, and then there it is, but this needs to be a negative to make it a credit. So make it a credit. And so there's that. And so there we have it. Now this thing should be in balance. That's our normal kind of entry. That's our entry if we left our numbers kind of like up top here. Now we're going to say, hey, look, these two numbers we wanted to basically, we want to change, right? We want to change. Let's highlight these. I'm going to say we want to change like this number, this number, this number, and this number. So those are we're going to change in accordance with these adjustments that we made to them. So in other words, you know, this is going to be like the starting number that we had here is here. We need to change it to that. This was the starting number at the 21. We're going to change it to that. This was the starting number here. We're going to change it to that. Now I'll just do it with another journal entry. So I'm going to say, all right, here's the investment and here's the income. And you'll see the kind of symmetry here as we do this. And so here's going to be the adjustment that we're going to make. Okay, so here's this number, which is we said this number, and we need to change it to that 99. So we got to bring it down. This is a credit, so we're going to debit it. I'm going to bring it down to that 99 by just taking the difference and making it a debit. So I'm going to say this is going to be a debit, which is going to be equal to, and I'm going to say this number and plus, so it'll subtract the two, this number. But then I need to put brackets, or I need to make it a negative. So I'm just going to put brackets around it and put a negative. So in other words, the 102.2 minus the 99.40, and then I need to make it a debit. So then make it a debit. Okay, and then the other side is going to be here. So now we're looking at the income. So the 21.7, the 21.7 is here. Now we basically need to make that the 18.540. So this is a debit. We need to decrease it to the 18. So I'm going to say negative. I'm just going to subtract these two out. This minus this. And so we just subtract those two out and make it a credit. And these are equal and opposite, right? And then we're going to see the symmetry down here as well. So we're going to say, all right, here's the non-controlling interest. That was, our journal entry was the 9.3. We need to make it that 9.6 now. So this is a debit. We need to increase it. So I'm going to say, all right, this is going to be equal to the 9.6 minus the 9.3. So there we have that. And then we have finally the net assets over here at the 43.8. We need to make it the 44 there. So I'm going to say negative of, and then I'm going to say this number plus this number, which again, that might look a little funny, but we're subtracting these two out and then making it a credit. So you can see, obviously, these tie out here. And if you were to match this out, you'd say, okay, so here's the investment, that is the 99.40. So there's the 99.40. We've got the income, that's the 18.540, the 18.540. We've got the non-controlling interest here, the non-controlling interest there, tying out now to the 9660, and the 43.8 and the 360 being the 44.160, the 44.160. All right, so there's going to be our first main entry. Let's go ahead and do our consolidation. We're going to sum these two up, P and S, and then we'll record that one out. Equals the sum of these two. I'm going to say copy. I'm going to paste that down. We're just summing it down as we've seen in prior problems. And now I'm just going to post this thing out and see what it looks like. We're going to say, all right, we got the investment here. It's not going to go down to 0 like we want, but it's doing what it's going. So we're just starting here. And then we have the 70,000. So we basically removed this set P, S's portion to bring us back to P's portion. Retained earnings, we're going to be picking up the 62, in essence removing S's portion to get us back to P's portion. Dividends, we're going to be removing the 17 in essence here to get us back to P's portion. Then we're looking at the income from S. It's not going to bring us down to 0, but like we say, this is going to be, we're removing piece by piece here. So we're left with an amount there. We hope that's 0 when we're done with this process, or else we're messed up. And then we're going to be down here, and then non-controlling interest. So non-controlling interest, and then the non-controlling interest here. There we have that. And then we're going to do our little adjustment to tie out to the table that we made, the investment in S. So here we're going to double click on this, plus the 3160. The income from S is down here. I'm going to double click on it, say plus. And then we've got the non-controlling interest here. So I'm going to double click on it and say plus the 360. Non-controlling interest and the net assets, double click here and plus. And there we have that. So that should put us back in balance. These things aren't down yet, but we're on our way. So let's see what we have next here. Let's do the next one to deal with the amortization and the depreciation for the current year. So we're just going to record the current year amortization and depreciation. So this is going to be the added amortization and depreciation for the current year. So I'm going to say, all right, we had depreciation is going to have to go up. Let's do it we could do this in 2 journal entries, but let's do just one journal entry and record both of these. Amortization And the other side, we're going to be breaking out. Well, let's calculate it first. Getting ahead of myself here. So the depreciation for the current year, the expense, is going to be equal to the added depreciation, which was the 22,000 divided by 10 years useful life. So we're going to have to increase that by the 22. Let's do the same thing for the amortization expense. For the current year amortization, we're going to have to increase it by the 47,000. This was the increase in the fair value over the book value at the point in time of purchase 2 years ago. And we're going to have to add this expense every year according to the straight line method 5-year life for this one. Okay, so there are those two. Now we're going to take that full amount, which is going to be the 11.6, and we're going to make the adjustment to the respective portions, 70-30 split, parent subsidiary breakout. So we're going to be breaking those out between the two income accounts that related to them, income from S and the non-controlling interest in S. So I'm going to say, all right, so then we have the income from S is going to be here, non-controlling interest in S. And then I'm just going to add those up and break it out on a 70-30 split. So I'm going to say negative sum of these two times the 70% for the controlling interest. And then I can just use my plug formula, but I'll do the same thing just to emphasize that this is going to be times 30%. This times, and I'll say 1 minus 30. So when you look at this worksheet, you can see the formulas, and that hopefully will tell you more. Okay, so then let's go ahead and post this out. So we're going to say, all right, depreciation then is going to be added by the 22,000. We have the amortization, which is going to be going up by the 9,400. Then we'll break that out between the income from S, because that was included in the equity method, 70% going here. We could see that in our equity method journal entries over there if we so choose. That's going to be the 8,120. Which you could see here. And then the other side is going to go to the non-controlling interest down here on the income statement. And that's going to be the 3,480. So that should put us back in balance. All right, next thing, let's go ahead and now think about putting the actual assets on the books that were different between the fair value and the book value at the point in time 2 years ago when the actual purchase took place, when P purchased 70% of S. So that means the machinery was up and the intangible asset was higher. So we're going to have to include those. So we're going to have to increase those balance sheet accounts now. So I'm going to say, all right, the machinery and equipment must have been higher. And I'm going to say that's going to be higher by, let's go on back and say that was $22,000 higher at that point. And then we had the intangible assets that were higher. Intangible assets were higher too. So we got to put those on the books with a debit. So we'll put those on the books with a debit of the 47,000. And now let's put the related accumulated depreciation. So we put the expense up top for the current year. Now we're going to calculate the accumulated depreciation, which is 2 years now. It's been 2 years that this has been accumulating. So I'm going to say, all right, now let's do the accumulated depreciation, which I'm going to say is up here. We could recalculate it, but we've got 1 year up top. So let's just multiply that times 2 now. Let's try that. I'm just going to say negative of this times 2 years. And we could do the same for the amortization. So the amortization, I'm going to say, it doesn't have another account. We're not going to call it accumulated amortization. I'm just going to decrease it. So it looks funny here because I have, the intangible asset twice in one journal entry. But one is representing the increase and the other is representing the decrease due to amortization that's going to be recorded directly against the intangible asset. So I'm going to say, all right, that's going to be negative of the amortization times 2. So that's going to be the 18. So this is going to be then, if I add this up, a net change on the asset side of things of 45,800. Which I'm going to break out between the parent subsidiary 70-30 split, but this time using the balance sheet accounts representing the equity method for the parent, having this recorded in the investment account, which will help this one go down to 0, which will make it go to 0, which is nice. and then the other side being on the balance sheet side of the non-controlling interest, and net assets. So I'm going to say, all right, then I'm going to pick up the investment here, and then we need a credit. So I'm going to say negative sum of all of this times the 70%, and then the non-controlling interest in the net assets is going to be the 30%. I could just do the negative sum formula, the plug formula, but just to emphasize, it's going to be the 30%, because I think that'll be, telling more when you look at the worksheet. So I'm going to say this is going to be times 1 minus the 70%, which will be the 30%. And there we have it. And then if we add this up, we should be in balance. So we're in balance down here. All right, let's record this out. So we're going to say, all right, the machinery is going to be the debit of the 22. The intangible assets here are going to be debited for the 47, increasing those. Then we've got the accumulated depreciation. Accumulated depreciation is going to be increased for the 2 years of the depreciation. And then the intangible asset's going to go back down because there is no accumulated amortization. So we're going to go back down for the amount of the amortization. I'm going to say, where am I right here? I'm going to say F2 plus F2. We're going to bring that on back down. Then we've got the investment in S. So the investment in S is going to be here. F2 plus F2. This is going to go down to 0. Now, is it? No. The investment in S is going to be the 3260. So we still got the 14 there. That's okay. I thought it was going to go down to 0, but it's not. And then we've got the non-controlling interest. I'm going to say F2 plus F2. That's going to be the 13740. All right, the next one we're going to do is also going to be dealing with the machinery and equipment, and that's going to be recording the amount of accumulated depreciation that was on the books 2 years ago at the point of purchase, which we're going to basically consolidate out. So in other words, 50,000 was on the books in accumulated depreciation 2 years ago. We're going to consolidate that out kind of like a purchase took place and decrease the accumulated depreciation and decrease the machinery. I'll do this pretty quickly because we've seen this in the past. So I'm going to say, all right, that's going to be decreasing or debiting accumulated depreciation. The other side going to the machinery. The amounts given to us in the problem, and it's going to be for 50,000 right there. So 50,000. That's going to be the debit and credit. Let's post this. So we're going to debit's going to go to the accumulated depreciation. So here we are here. I'm going to say F2 plus F2. We're going to pick up that debit. And then we're going to be crediting the machinery. So within the machinery, F2 plus F2. We're going to scroll on down and credit then the machinery. That'll put us back in balance. Okay, so now we're going to deal with the journal entries that will be from our worksheet over here. That's going to be with these reversals that we need to put in place. And you can see we kind of included these in the equity method here. Now we're going to be dealing with them in terms of our elimination entries. So first, I think about it this way. I usually think about, okay, I'm going to be dealing with these top two first, or this one first, prior year deferral transactions. And I usually start with basically the cost of goods sold is going to be affected by this 11.6. So that's going to be the first. We're going to reduce cost of goods sold with a credit. So I'll put that on top, even though it's a credit, because that's the first thing I would think about. And I'm just going to build this as I would think about it. So I'm going to put the credit on top. And that's going to be for the cost of goods sold. Now I'm going to be breaking that out between the investment account in S and the non-controlling interest, basically the balance sheet accounts. So balance sheet account that are related to the split that we'll have, that's going to be then the investment in S and then the non-controlling interest in the net assets. Now we're not going to be breaking this out in a 70-30 split. We're going to be breaking it out between this breakout, the parent and the non-controlling interest here, which happens to be a 70-30 split here, but I would be pulling this from your table up top. So pull it from the table up top. I'm going to say this is going to be equal to, then We're going to scroll back up. And the reason is because if there was a reversing entry up here, it would just be on the P side and not on the non-controlling interest side. So due to the fact that we don't have any reversal for the down, then it's still going to be the 70-30 split. But if we did, then it wouldn't. So you want to make sure that you're pulling it from the table so it'll work in every case. So there we have it. All right. And then if we add these two up, so that looks good. So let's go ahead and record this out. So we're going to say this is going to be the cost of goods sold. Cost of goods sold is going to be the 11.6. And then we have the investment in S. The investment in S. So there's that. I'm going to say F2 plus F2. And we will then pick up the 8120. Then we have the non-controlling interest in the net assets, F2 plus F2. And so there we have that. Now the next entry you would think would be these two, and that's what we normally do here. And we'll be dealing with that. Well, first, notice we're going to have to deal with this kind of funny transaction here we had once again, the 2000X2 Upstream transaction that wasn't sold. And nothing was sold in 2000X2, and it wasn't all sold in 2000X3, resulting in this ending inventory of the 8,400 of the gross profit here. So that's what we're going to be dealing with first. So we're going to have to credit inventory for that amount. So I'm going to go back on over, and we're going to say, all right, I'm going to put the inventory on top because this is the one I would think about first, even though it's a credit. Once again, I'm gonna build this as I think about it, rather than debits on top all the time. So we're going to be picking up that 8,400. Then we're going to break this out in our normal split, the 70-30, to the investment account, the balance sheet accounts up top, the investment in S, and then the non-controlling interest net assets, 70-30 split. So I'm going to say this is going to be equal to negative of that number times the 70. Scrolling up, picking up the 70, and then I can use the negative sum or take that negative of that number times 1 minus the 70, which of course will be the 30%. So 1 minus the 70 or the 30%. Let's post that out. So I'm going to scroll up and say, all right, then inventory here is going to be going that 8,004, and then the investment, I'm going to the investment in S. So investment in S, I'm going to say F2 plus F2, and that's going to be for the 5880. Notice that brings this down to 0. So that's another way you can kind of see that we needed that. I undid that. You could see that we need that there. So that's another way you can kind of, back into this, to mold this over to think about it. And then we got the non-controlling interest in NA. So we're going to go into here and say this is going to be F2 plus F2. Okay, so there we have that. And then we can do what we would kind of normally think about at the end process here, and that's going to be we're gonna take a look at these items, which are going to reverse basically the inventory of the 14.4 and deal with the fact that the revenue has been overstated, right? We got the intercompany revenue. So I'm going to reverse the revenue and the cost of goods sold and the inventory with these numbers here. So I'm going to say, all right, let's start with, I would think about revenue first now. So we haven't dealt with the fact that the revenue is overstated. So I'm going to pick up the revenue, and that's going to be for the current year intercompany transactions. Revenue will be too high for the 2003 intercompany. So that's going to be the downstream and upstream for the 32,000 revenue here, and then the 90,000. So those revenues need to be reversed. Revenue is a credit balance account, so we're going to debit it to make it to go down. And then I would think about the inventory next. So I'm going to pick up the inventory because that I'm going to pick from the other side of our adjusting worksheet that we made up, which is going to be that's going to be our bottom two numbers, the 10 and the 10.4 and the 4. So I'm going to say, all right, this needs to be then the sum of these two numbers. And there we have that. And that kind of shows us that we've basically done, we've included these items down below, down here, when considering the effect on cost of goods sold, investment, the cost of goods sold, the revenue, and the inventory. All right. And then the difference is going to be to the cost of goods sold. So I would use that as the plug then. Cost of goods sold is going to be the negative sum of these. Okay, and so let's record that one. So I'm going to say, all right, revenue up top, revenue. It's going to be here. That's going to be the 122. The inventory then. The inventory, I'm going to say, is F2 plus F2. Scrolling back down, picking up the old inventory. And then finally, and so there we have that. And finally, we got the cost of goods sold. Cost of goods sold. Here, I'm going to say F2 plus F2. And there we have the cost of goods sold. So there's our ending numbers. So we've got the zeros here. We basically backed out the equity section here to get us basically back to the P equity section. Couple check figures you can take a look at.